Most people who struggle with journal entries aren't struggling with debits and credits. They're struggling with the logic underneath them. Once you see that every debit and every credit is just a move inside a single algebraic equation, the rules stop feeling arbitrary. That's what this episode is about. Everything in double entry derives from one identity: assets equal liabilities plus equity. That's not a convention, it's a definition. Equity is the residual interest in assets after deducting liabilities. Because it's an identity, it must hold at every single point in time, after every single transaction, no exceptions. Your job as an accountant is to record transactions in a way that preserves this balance. Now expand the equity side. Equity grows through contributed capital and retained earnings. Retained earnings grow through income and shrink through expenses and dividends. So the full equation is assets equal liabilities plus capital plus income minus expenses minus drawings or dividends. Every account in your chart of accounts lives somewhere on this equation. That placement determines its normal balance. Here is the rule stated precisely. The left side of the equation, assets, increases with a debit and decreases with a credit. The right side, liabilities and equity, increases with a credit and decreases with a debit. Income sits inside equity on the right, so income increases with a credit. Expenses reduce equity. They sit on the left conceptually, so expenses increase with a debit. This is not arbitrary. It is a direct consequence of which side of the equation each account lives on. Let's make this concrete with a worked example. A company borrows 100,000 Rand from a bank on day 1. The bank transfers cash to the company's account. We need to record two effects. Cash goes up and a liability, the loan, goes up. Cash is an asset, so it increases with a debit. The loan payable is a liability, so it increases with a credit. Total debits equal total credits, 100,000 on each side. The accounting equation stays balanced. Now a slightly more complex entry. The company buys equipment for 80,000 Rand, paying 40,000 in cash and financing the remaining 40,000 on credit from the supplier. Three accounts are affected. Equipment, an asset, increases, so we debit it for 80,000. Bank, an asset, decreases, so we credit it for 40,000. Accounts payable, a liability, increases, so we credit it for 40,000. Total debits, 80,000. Total credits, 80,000. Balanced. Revenue and expense entries are where candidates most often slip up because income and expense accounts are temporary. They ultimately flow into retained earnings and close at year end. When you earn revenue, equity increases, so you credit revenue. When you incur an expense, equity decreases, so you debit the expense. The impact on the accounting equation is felt through equity, even though the income statement accounts are separate lines in your ledger. Contra accounts deserve specific attention. A contra account sits opposite to its paired account's normal balance. Accumulated depreciation is a credit balance account that offsets the debit balance cost of property, plant, and equipment. The allowance for doubtful debts is a credit balance contra to trade receivables. When you record depreciation, you debit depreciation expense and credit accumulated depreciation. You are not crediting the asset directly. This preserves the gross cost disclosure required under IAS 16 and IAS 38. Let's look at a depreciation journal to lock this in. A machine costs 200,000 Rand. Annual straight-line depreciation over 5 years is 40,000 Rand. We debit depreciation expense for 40,000. That reduces equity through the income statement. We credit accumulated depreciation for 40,000, a contra asset account. The carrying amount shown on the face of the balance sheet is cost less accumulated depreciation, but the gross cost remains intact in the ledger. The most frequent errors in practice come down to three patterns. First, debiting a liability instead of crediting it when it increases, usually because someone is working from memory rather than the equation. Second, getting confused by bank statements. Your bank shows your deposit as a credit because from the bank's perspective, you are a liability to them. Your own ledger shows the bank account as a debit normal asset, the opposite. Third, forgetting that dividends declared debit equity directly, not the income statement. They are a distribution, not an expense under IAS 32. One final point worth emphasizing for those moving into IFRS reporting. The debit-credit mechanism is universal, but the classification of accounts can shift depending on the standard. Under IFRS 9, a financial liability measured at fair value through profit or loss can create a gain, a credit, even as the liability balance increases. Under IFRS 16, the lease liability initial recognition produces a debit to right-of-use asset and a credit to lease liability simultaneously. The mechanics never change. What changes is which accounts you are moving. To bring it all together, debits and credits are not arbitrary rules. They are a systematic way of preserving the accounting equation with every transaction. Understand where each account sits in the equation, and you will never need to rely on a mnemonic again. Reason from the equation: check that debits equal credits, and confirm the balance sheet still balances. That discipline is what separates a technical accountant from someone who just posts entries.